Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak. I'm Nathan Hager with Karen Moscow as we get ready for the first trading day in which the federal government will be open in 43 days. We're joined by Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Really great to have you with us on this first day after the government shutdown. Mike, now that it's over, now what? Good morning.
Good morning, Nathan. Yeah. Well, I think most people probably won't feel the effects. I'm sure the government employees are happy to get back to work. And look, I think from our standpoint, from a market standpoint, I mean, this, the longer that this kind of, lagged into the holidays, it definitely became a risk factor from both a growth standpoint and also from a financial liquidity standpoint. So, I think there is a bit of a sigh of relief. The markets have traded better into this now that it's behind us. But let's be honest. I mean, I don't think they've really solved some of the main issues. So this is one that could pop up again in as early as January. So we'll keep an eye on it. But I think we averted the worst of it.
Could there be a lag when it comes to releases of government data? We heard the White House say that October CPI and jobs might never come out. Could that have a market impact?
Well, it's just more of the same, which is there is this tension, and we've written about this, that we think there is this tension between the market's expectation and what the Fed is doing. And part of that does relate to the data itself. I would say that the issue with the data is twofold. Number one, we may not get it, and so it's just a further delay, which will delay the Fed's ability to, cut rates maybe as much as the market wants. And also, I've made the case, and I think other people have too, that these data are somewhat they're very lagging, and they're not as accurate as they have been pre-COVID. Since COVID, some of these data, the collection of themselves has been a little bit erratic and a little less reliable in that regard. So we do have a little bit of a data problem with or without the shutdown, and I think this all stems back from COVID, and I think this is making the Fed's job harder.
Does it change your view on what the Fed does on interest rates? I think you were calling for something like, 6, maybe 7 interest rate cuts next year. Does that change now?
Well, I think it's 5 to 6 now, or economists have over the next year. But still, that's more than what the market's anticipating. Right now, the market's anticipating about 3.5 cuts between now and the end of next year. So, I mean, look, I think the issue, it's not an issue, but I think one of the concerns that the market has had, one of the reasons why it's been narrow, is that, the market kind of wants more Fed cuts. In order to get the private economy really moving, we do need kind of that base rate a bit lower, and that's why we've kind of stayed at the quality curve and why the market performance has been quite narrow. So, I think because of the effects of COVID, the kind of the boom bust on inflation itself, the Fed is probably going a little bit slower than they would normally, which I don't think is necessarily the wrong decision. But there is that tension, as I mentioned before, between the market and how fast the Fed is moving.
It's been an interesting move in the market in the lead up to this shutdown coming to an end. While the broader market's been moving lower, we've seen the Dow Jones Industrial Average hit new record highs. Does that point to a new direction, a new narrative for the market?
We think so. I mean, we've kind of held back on trying to make the kind of small cap, mid cap broadening call, but now we think we're getting closer to that moment where we do think we're going to see broader performance in 2026, mainly because the earnings story now is improving. As we've been saying for quite a while, a good chunk of the private economy has been in a recession for many years. And we think that it's now emerging from that. Some of that's due to some of the policy changes, and quite frankly, there's just pent up demand. But the missing piece there, going back to the Fed again, not to put too much pressure on them, but we do need lower rates for that private economy to get moving. The good news is, Nathan, is that in the third quarter so far, the reporting season, we are now seeing double-digit earnings growth on a year-over-year basis for the median stock, and that's the first time we've seen that kind of growth in 4 years. So I think there are early signs that we're seeing a broadening of the earnings story, and that's what ultimately will lead to better, broader performance in the stock market next year.
Are you starting to think about a number in terms of where earnings revisions could go into next year?
Well, I mean, I think the consensus right now is low double digits, and we think that's very achievable. We'll leave it at that. We're actually working on our year ahead piece that'll come out at the end of next week.
Okay, is the need for interest rate cuts there for the market, or can the market continue to rally higher even if its expectations aren't met in terms of monetary policy?
Well, I think I don't think the market's necessarily in trouble if they don't exceed expectations. But I do think the broadening story requires the Fed to get ahead of the curve, as I'd like to say. And I measure, kind of the Fed, in market terms, are they ahead or behind the curve by looking at the 2-year Treasury yield. So right now the Fed funds is still about 40, 50 basis points above the 2-year Treasury yield. And I would like to see the Fed get below that level, and then you'll see that broadening out. But the economy is not in bad shape at this point. I think the worst of the economy, sort of slowdown is behind us, and that was, we priced all of that in April. We've written about this. That was the end of this rolling recession, and we're into a new bull market now. But markets like to challenge authorities, monetary policy, et cetera, and if they're not happy, they'll make them know, and then they'll get what they want. But right now it seems like we've got a decent balancing act that's going on.